Today, we're cutting through the noise in alternative investments to talk about, well, the single biggest game changer happening right now.
We're talking about the fundamental shift in who is actually funding the private markets.
Exactly. For decades, general partners, the GPs, the fund managers, they had a pretty predictable playbook.
Oh, absolutely. They relied on a stable institutional capital base. Pension funds, huge endowments, sovereign wealth funds. These were the limited partners, the LPs.
And they understood the long game.
But that whole foundational structure it's shifting dramatically. It's forcing a pivot toward individual or retail investors.
And that trend, the retailization of alternatives, is what we're digging into. It's introducing some serious complexities that I think most GPs just haven't had to manage before.
That's the heart of it.
Okay, let's unpack this then. Our mission for this deep dive is to take the key data, the really critical strategic implications from the SS&C Intralinks report, the retailization of alternatives, which uses a ton of PitchBook data, and just distill it all down.
We need to understand what this seismic shift really means, specifically for the GP's back office, for their operational strategy.
And there's a real tension here, isn't there?
It's fascinating. I mean, on one hand, private markets are still incredibly lucrative. The returns are there, and that's what's enticing this whole new class of retail investors.
But on the other hand,
the markets are facing these intense headwinds. There are financial constraints pushing GPs to, frankly, desperately seek new diversified capital sources.
so you have this convergence of market necessity and new opportunity.
And that's what's creating all these new regulatory and operational demands that the big institutional LPs, well, they just never imposed.
So if you're a GP listening to this, if you're running a fund, where do you even start? Where do you focus?
We see three crucial areas.
Yeah.
First, the current market reality, why this is even happening. Second, the totally new operational challenges that come with retail investors. And finally, the absolute necessity of digital infrastructure to manage all this.
Let's start with that market reality check. Why are GPs suddenly forced to court retail investors?
It all comes down to the macroeconomic tightening we've seen over the last few years. Liquidity for those traditional institutional LPs has really tightened up.
Which just makes fundraising so much harder.
So much harder. And the numbers, they're stark. They show a really clear institutional pullback.
How bad is it?
Well, if you look at global private equity fundraising, the annualized fund count is declining. It's actually heading toward the lowest number recorded in a decade.
A decade. Wow. That suggests a long, hard slog for GPs trying to raise that next flagship fund.
Precisely. And it's affecting the total pool of money that's even available to be deployed.
You're just talking about dry powder.
Exactly. That's the committed capital LPs have promised, but the GPs haven't invested yet. For the first time since the pandemic, global private capital dry powder actually dropped year over year.
What to what?
It fell from about $4.3 trillion in 2023 down to $4 trillion in 2024. Now, what's important to note is that the net asset value, or NAV, it still grew.
So the funds still hold value.
Right, the assets are valuable, but the actual deployable cash is shrinking.
We see the dry powder shrinking. But what did the report flag as the single most painful reason for this institutional pullback?
It's stalled liquidity. It's the lack of exits.
Ah,
Institutional investors can't commit new money if they aren't getting cash back from their old investments. And the data on realized returns, it's like a fire alarm going off.
okay, give us a number.
The Q1 2025 realized return was only 2.9%.
2.9%. That's what? That's almost half the long-term median, isn't it?
It is. The 13-year median is 5.8%. So when you're realizing half the median performance, that's not just a signal. It's a failure to deliver the cash flow that LPs need to reinvest.
When the money doesn't come back, they can't send it out again.
Simple as that. They're forced to hold capital rather than deploy new funds.
And this feeds right into the denominator effect, which always sounds complicated, but it's really just a portfolio imbalance.
Exactly. It's when the public market, part of their portfolio, the denominator in their allocation math, drops in value. Suddenly, their private market commitment looks proportionally huge.
So they're over-allocated to alternatives, even without making a single new investment.
And because of that, endowment and pension fund commitments, they've dropped off a cliff. From almost 5,200 in 2021 down to just over 1,000 year to date.
That signals massive constraint on institutional capital.
A very serious material constraint.
So let's connect the dots here. For a GP, the strategic takeaway is the old playbook isn't working. With institutional capital so constrained, you have to look elsewhere.
And that untapped, massive source of liquidity is the retail investor, a demographic that was previously excluded but is now accessible thanks to financial innovation and, critically, those regulatory shifts.
Which brings us right to the core challenge we mentioned.
Yeah,
Because retail investors are, well, they're fundamentally different from any LP GPs worked with before.
it's a whole different ballgame. They introduce a level of complexity that GPs have to solve in their back office, especially around data management and due diligence.
But hold on. Structurally, if a retail investor is buying into the same fund vehicle, why does the source of the capital matter that much to the GP's operations?
Because their expectations and the regulatory oversight that comes with them are completely different.
Okay, let's break that down.
First, their transparency needs, they're just so much higher. A traditional LP, they're doing their own deep due diligence with a whole team. A retail investor,
They need it spelled out for them.
they require it and regulators demand it. They need far greater clarity in what is, by its very nature, a pretty opaque asset class.
And the relationship with their own money is just different. An institution commits capital and is ready for a 10-year lockup.
Precisely. And that leads to the second major difference, liquidity expectations.
Right.
Retail investors, especially the ones coming in through these new semi-liquid funds, they expect more frequent transactions, higher volumes of redemptions.
So a GP's legacy back office maybe was built to handle 50 institutional relationships with capital calls twice a year.
And now it suddenly has to handle thousands of smaller investors who all want the option to redeem their money quarterly. That is an operational nightmare if you don't have the right digital infrastructure in place.
Okay, so transparency, liquidity, and the third one has to be the regulatory guardrails. This is where that fiduciary duty really hits home for the GP.
It's absolutely crucial. Regulators around the world, they're loosening the definitions to allow this access, but they are not eliminating oversight. Not at all.
In fact, it's the opposite.
Exactly. Increased scrutiny is expected globally. The onus, the responsibility to protect these less sophisticated retail investors from things like liquidity mismatches or lack of disclosure, it falls directly on the fund managers.
So your data management has to be perfect,
Mhm.
audit ready, non-negotiable.
If it's not, you're at risk of breaching your fiduciary duty. It's that serious.
Okay, this is where the rubber meets the road. We know the challenges. How are GPs actually enabling this access right now? It seems like they're moving incredibly fast, using three main methods.
They are. And the first is the product itself, the investment vehicle. Fund managers are really capitalizing on this by doubling down on semi-liquid fund vehicles and ETFs.
These evergreen structures.
Yes, because they offer that periodic access to capital, that quarterly or monthly liquidity that retail investors are demanding. And the growth is explosive. Net assets in semi-liquid funds have jumped 60% since just 2022.
60%. That confirms this structure is core to the whole strategy.
It is.
And we're also seeing these huge high-profile partnerships and M&A deals that show this isn't just a side project. It's a core strategic priority for the biggest players in the world.
Oh, for sure. Think about the strategic imperative behind a deal like BlackRock spending $24.5 billion to acquire Global Infrastructure Partners in early 2024. Or BlackRock and Partners Group co-launching an all-in-one private markets solution that's specifically tailored for retail wealth advisors later that year.
These massive deals, they aren't just about adding assets under management or AUM.
No, not at all. They're about acquiring the distribution channels, the technology, and the operational expertise you need to serve this new fragmented customer base at a massive scale.
And all of this is being enabled by the regulatory tailwinds that have been building for years.
That's the foundation for all of this. It really started in the U.S. with Regulation A back in 2015, and then the expansion of the accredited investor definition in 2020.
And Europe followed suit.
Yes, with the evolution of LTIF 2.0 in 2024, which significantly broadened the scope for funds to market directly to retail investors. These shifts confirm that the industry's long-term bet on retailization is paying off. The legal path is opening up.
Let's circle back to something you mentioned earlier, liquidity.
Yes. To manage those heightened liquidity expectations, which is really the single biggest operational difference, GPs are looking very heavily towards secondaries transactions.
So the secondary market is becoming a critical piece of the puzzle.
It's taking on a crucial, necessary role as a liquidity mechanism for the entire private market.
Explain that for us. Why are secondaries so key to this whole retail conversation?
Because they directly solve the two major roadblocks for retail investors: the redemption issues we talked about and this perception of mispricing.
How so?
Well, when you have a secondary transaction, it accelerates liquidity for the original investor. And that liquidity, in turn, generates real-time pricing transparency.
In an asset class that's otherwise valued, what, maybe once a quarter?
At best, so that combination of liquidity and price clarity is hugely appealing to a retail base that really prioritizes both.
And the data shows this capital is flowing into secondaries, but it's also becoming highly concentrated.
It is. In 2025 year to date, only 38 secondary systems have closed, but they've already generated $98.4 billion.
Wow. So that's huge volume across a very small number of funds.
Exactly. And it suggests that we're going to see fewer but significantly larger secondary transactions on the horizon.
What's the implication there? Does that concentration mean that only the market's largest, most established, and I guess most exit-ready private companies are getting that liquidity?
That's exactly it. This capital flow, it promotes the allure of private markets to the retail segment by showing off these massive returns, but it's mainly providing those liquidity windfalls for the biggest GPs invested in the largest companies.
Okay, let's shift focus for a second. Let's talk about the early testing grounds for these retail products. It wasn't the mainstream public right away.
No, it started with angel and high net worth individuals, or HNWIs.
Why them?
They were really the pioneers. They resembled the retail profile, they're individual decision makers, but they were already familiar with the private market ecosystem.
So they were a good bridge.
A perfect test bed. Back in 2015, these individuals were participating in almost 6% of all global VC deals. They were crucial before the outreach expanded to the wider retail pool.
And now we're seeing that evolve into platforms anyone can access. We see platforms like Robinhood capitalizing on the momentum of huge private players like OpenAI or private shares of Tesla to give retail investors their first taste.
It's making the inaccessible suddenly seem tangible.
And to help these new investors actually understand performance, we're seeing some important financial innovation.
Absolutely, like the new Morningstar US Modern Market 100 Index.
What's so important about an index like that?
It's really the first index to truly blend public and private market benchmarking in a cohesive way.
So for a retail investor who's used to tracking the S&P 500,
This gives them a standardized, objective framework to look at private market performance in a language they already get. It helps bridge that critical gap in market understanding.
so bringing it all together, what does this trend mean for GPs today?
Ultimately, it means they have to proactively build a robust digital infrastructure to manage all these new complexities. And this isn't just about showing off fancy tech.
No, this is critical for survival.
It's critical for maintaining audit-ready documentation and for granting the kind of oversight that regulators are going to demand as scrutiny increases.
So we're talking about a complete operational overhaul, not just, a cosmetic refresh on the website.
Absolutely. Think about the challenges we laid out. GPs need to manage higher transaction volumes, more frequent reporting, and meet these incredibly high investor expectations for transparency.
You can't do that on spreadsheets.
A GP running on spreadsheets and manual processes for 5,000 retail investors is it's just not scalable. It is guaranteed to create massive compliance risks.
So walk us through what that technology actually needs to do. How does it help a GP meet the needs of LPs with these widely varying experience levels?
The infrastructure has to handle data ingestion and standardization at a huge volume. You need AI-driven tools, particularly to automate and streamline investor onboarding.
Things like the KYC and AML checks.
Exactly. The know your customer and anti-money laundering verification, that has to be automated.
That automation handles the speed and the volume. But what about the investor experience side?
That's where tailoring comes in. The right technology allows GPs to segment their investor base and create educational materials specific to different levels of sophistication.
So a veteran LP doesn't need a tutorial on what private equity is.
Of course not, but a first-time retail investor absolutely does. A single unified digital portal can make sure every investor gets the exact level of reporting and education they need.
All while ensuring that standardized, audit-ready data is flowing back to the GP.
That's the key.
It really sounds like the technology solution is the bridge between regulatory compliance on one side and the demand for scalability on the other.
That is the core takeaway for GPs. Building this digital infrastructure now, it ensures you're compliant, yes, but it also positions you as a forward-thinking leader.
And that's what will let you attract and retain this growing and very demanding class of investors.
Efficiently and securely.
Okay, we've covered the market need, the fundamental operational shift, and the technological requirement for survival. So, time for a final provocative thought for you, the listener. to consider.
Let's do it.
Given this increasing flow of capital into fewer, yet much larger secondary funds, which, as you said, tend to focus on these huge exit-ready companies,
Oh.
how will the GPs who manage smaller, less established companies adapt their own liquidity strategies to remain competitive and attractive to this newly expanding retail wealth segment?
That tension between the massive scale at the top and the need for accessibility across the market, I think that will define the strategic landscape for the next decade.
A fascinating question to ponder. This has been the Deep Dive's analysis of this major shift in alternative investments, drawn directly from the report, The Retailization of Alternatives.
And to succeed in this new market, investor relations teams just need a smarter, more efficient way to manage the entire fund lifecycle. From complex compliance all the way to seamless investor communication, technology is the answer. It provides the gold standard for fund management, and it ensures the top global fund managers can operate with efficiency, transparency, and in full compliance.
For more insights and the full analysis, you can download the complete report now. Just click the link right there in the show notes. Thanks so much for listening. We'll see you next time.